Today, we're going to be thinking about a question that I want to make sure you have an answer to. What is a good rate of return for your 401k? Why do I want you to have an answer to this? Because when you set the bar, when you have a plan, then that will impact how you go about building your portfolio. When it comes to this, you have to consider your own risk tolerance, your age, how far away from retirement are you? But I'm going to give you a starting point that I think you can incorporate, and that is the benchmark of the S&P 500 performance. At a minimum, is your retirement account growing at that rate? So, let's get started answering this question. What is a good rate of return for your 401k? Historically, financial advisors have said that a realistic amount is 5 to 8% per year for a modestly aggressive mix. And according to many sources, that's where most people are landing in that 6 to 8% range. Once you factor in different fees and things like that, this range of about 5 to 8% comes from the fact that many 401ks are a mix of stocks and bonds, not 100% strictly stocks. So, if you want to be more aggressive with lots of exposure to stocks, you might have to aim for higher, but you also taking on more risk. So, here's a look at the performance of the S&P 500 since 1980. We're not done with 2025 yet, so not sharing those total results yet. But year to date for 2025, it's up 16.45%. Now back to a longer time frame for you to take a look at. So why am I using the S&P 500 as the bar that you should try to achieve when it comes to your investments? It's because the S&P is a common benchmark. It represents the 500 largest US companies. Over long time periods, the average rate of return for the S&P has been around 10%, depending on the time frame. So as you get closer to retirement, you should plan on shifting to something more conservative in case we are in a stretch of time like you see here. We had from 2000 to 2002 with 3 years of a decline when it comes to the S&P. But you also see that after those 3 years, up 26%. And when it comes to the S&P, whether we're looking at this relatively short time frame or back 100 years, it has always recovered. So when it comes to my strategy when building my retirement portfolios, I do a foundational investment into something like the S&P and FXAIX, for example. And then I incorporate more growth-focused funds to aim for higher returns. But with that will come more volatility. So here's a quick example of that. My FXAIX is here in the purple. Over the last 5 years, the rate of return is about 102%. FSPGX, which is Fidelity's large cap growth index, has a rate of return of 115% in that same time frame. And then SPMO, which is Invesco's S&P 500 Momentum ETF, is up 150% over the last 5 years. Now, if you are working for a company, these may not be options that you have available to you to invest into, but I'm bringing this to your attention. I want you to set a standard for yourself because many people are just defaulted into the target date fund, which is a mix of stocks and bonds with that lower performance of that 5 to 8% per year. It's modest, it's conservative. And if you don't dig in, reach out, and find out what choices are available to you, you could be losing out on so much growth when it comes to your retirement account. So this is what usually happens. In many cases, you sign up for the 401k, you decide on your amount, your percentage, and then you are defaulted into a target date fund that is in line with your age. But until you ask, like I'm encouraging you to do, you don't know what other options may be available that can have you on track to have so much more significant gains when it comes to your portfolio. I don't want you to think I'm investing into my 401k. I'm getting my company match. We have to take it further. We have to know, what are we investing into? What is the rate of return? What are the fees associated with my investment choices? Those fees really matter. A 0.5% or 1% may not sound like much, but we have to think of that over decades. And as your portfolio grows, that 1% is going to be against $50,000, then 150, then 250. And as your portfolio grows, the amount that you're losing to fees is also going to be increasing, eating away at your returns. We're already battling with inflation. Our bar for planning used to be this, the 4% rule, but this was created off of data from 1926 through 1976. Now, we've seen in our own personal finances, prices have increased so drastically. We have to be ready to be even more prepared and consider upgrading this to 4.5%, 5%, or even more. But take the time to evaluate your numbers. Consider, what are you on track to achieve when it comes to your investment portfolio, along with Social Security, pension, other income that you anticipate receiving. But take these things into consideration. Know what you're invested into. Have a complete understanding of the performance and fees to make sure that you are maximizing your money. Know all of your investment choices. Take control of 401ks from previous jobs to make sure that they are on track and still growing. Once you've made your decisions, know what you're invested into, but don't obsess over it. Stick to your plan. Know that a diversified fund will recover in time. And we go through stretches of time when the market has a pullback. Again, you have to keep in mind your retirement age when planning so that you can shift to something more conservative as you approach your retirement age. I try to stick predominantly to funds, not individual stocks, but I don't want to be overly conservative. I want to be on track for growth in line with the S&P 500 or more. And from my personal experience, having the highest exposure to stocks at this particular time is what has me on track to achieve that goal. Looking back over the last 5 years, the S&P is up 88.25%. Let's compare that to two bond funds, BND, the Vanguard Total Bonds Market Index Fund, over the last 5 years, down 15.38%. And over the last 5 years, the Fidelity US Bond Index Fund, FXNAX, is down 14.74%. The performance of my high yield savings account is outperforming bond funds. So when it comes to my portfolio, I'm sticking with investing into the S&P and other funds for more growth like FSPGX. Now, back to our question of the day. What is a good rate of return for your 401k? A rate of return of 10% is average, using the S&P as your benchmark. If your portfolio is achieving 5 to 8% or less, that's below average. I'm encouraging you to be in tune with what you are currently achieving, and then from there, make strides to make improvements. Have an understanding of what options are available to you through your employer. If it's a 401k from a previous employer, take a handle of it if it's not currently thriving. I don't bet my entire portfolio on those high growth stocks, but I'm creating a mix in order to have that stability and additional growth for now, not shifting to anything super conservative because retirement is not right around the corner for me. And before we wrap up for today, don't forget to use the investment calculator to help you with your goal setting. I put in a scenario here of at $250,000 starting amount at that 10% rate of return that the S&P 500 historically gives us over the next 15 years, contributing $400 monthly would have you on track to have $1.2 million. So take some time, put your numbers in. How much do you currently have when it comes to your retirement portfolio? Monthly contribution, how many more years you'll be investing, and create realistic goals for what you are trying to achieve. So put the work in today. I don't want you to work for decade after decade and at the end of the road have any struggles. Realize that you missed out on the opportunity of investing with intention and truly building wealth that can help you to be on track to take care of your older self. If you made it this far into the video, I hope you already are subscribed to the channel. But if you're not, I am Lisa J. Stocks here sharing my financial journey. Never financial advice, just strategies that have been working for me as well as stock market news. I hope you enjoyed this video. Make sure to like, subscribe, hit that notification bell, and check out my referral links. Thanks for watching. Okay, bye.